You want to build a new home, but you have no idea how to pay for it. You're not alone, and the wrong financing strategy can cost you big. The good news, there are 4 proven ways to finance your new build in Australia, and I'm going to break down each one for you fast. The 4 financing options we're going to cover in this video are construction loans, home equity loans, bridging loans, and home and land package loans. These apply if you're building a new custom home, doing a knockdown rebuild, upgrading to a bigger home, or buying a home and land package. By the end of this video, you'll know exactly which option is right for you and how to avoid costly mistakes. Stick around, because I'll also give you a quick cheat sheet on choosing the right one. Let's dive in. The first and most common way to finance your build is with a construction loan. Think of it as a pay-as-you-build plan. Instead of getting one huge lump sum, the bank will give you money as the build progresses, and they'll inspect the work at each stage before making the payment. The best part about this, you only pay interest on the part that you've drawn down, not the full amount. That is going to keep your costs lower while you're building. One of the key benefits of this type of loan is that you have lower interest during the build. Because you're only paying for the interest on the funds that you've drawn down, your repayments are going to stay smaller until the build is finished. And once the home is built, the loan flips into a normal home loan. So then you just continue with your regular mortgage repayments. However, this does mean that there will be more paperwork required, and the bank will require a signed building contract and council approved plans upfront, doing staged inspections throughout the build. The other consideration to keep in mind is that they will only lend out based on a fixed amount. So if you make any changes or you go over your budget, they're not going to be covering that. You need to make sure you have extra cash in case that does happen. Let's say your construction cost is 500K, and after the slab stage, you draw down 100K to make the first progress payment. After that, you're only going to be paying interest on that 100K until the next payment is due. And this will continue throughout the build. If you're buying a house and land package from a developer or a builder, the financing is actually 2 loans rolled into one process. Firstly, you take out a loan to buy the land, then you take out another loan for the construction. The bank might organize them together, but it's actually 2 different loans organized into one process. So during the build, the land portion that you've taken out, you'll be paying interest on that whole amount. And for the build, you'll pay interest as the money is drawn down throughout the build. So it's basically just a construction loan, but with an additional land loan upfront. One of the key benefits of this type of loan and build is that you only have to pay stamp duty on the land portion of the amount and not on the build. Whereas if you were buying an existing property to knock down rebuild, you'd pay stamp duty on the whole thing. So you're saving some money there. You're also getting a brand new home with a fixed price, so there's going to be fewer surprises. And if you're a first home buyer, you'll likely qualify for grants and incentives as well. But you do have to remember that with this type of loan, you start paying interest and repayments on the land from the get-go. So it's like having 2 loans before you even start living in the property. So let's say you buy land for 700K and there's an additional 600K for the build on top. Now the 700K, that will be the land loan that you take out up front, and then the mortgage repayments will start on that straight away. For the 600K build, as the progress payments are made throughout the build, your repayments will gradually increase throughout the term of the build. And then once everything is complete, this will all be rolled into one loan, which will be like regular mortgage repayments from that point onwards. If you own a home or you have a lot of equity built up on a property, a home equity loan might be the best option to finance your new build. So this means borrowing against the value of your current property. It's like tapping into your current house to build the next one. So basically, the bank will let you borrow money against your current property's value, and then you can use that for your new build, either as a deposit or to pay for construction costs as they come up. The biggest advantage of this type of loan is that you don't have to have much cash saved up, and you can use the cash that you've built up as equity towards your build. Also, with an equity loan or a line of credit, you can have a pool of money sitting there that you can draw down as the construction progresses. So if there are any surprises or you have unexpected costs, there's a pool of money that you can reach into to make sure that the build continues. But you do have to note, this is going to mean that you're increasing the amount of debt you have against your current property. So make sure you think about that carefully. It also means that you're going to have higher total debt as you're adding to your current mortgage until you reduce that debt, say by selling your old house once you've moved into the new one. You'll be servicing two loans at once. Let's say you have a property worth $1 million and there's an existing loan of $300K that's left on that property. You could refinance up to 80% of the current value of your property. So that's up to $800K, which would be an additional $500K that you could get access to. If you were to then sell that property, you could pay off that $800K loan that you've got sitting on there. That'll leave you with a much smaller total debt for just the new house that you've built. So basically, you've used the value of your first property to then go and build your second property. Finally, we've got bridging loans. A bridging loan helps when you want to buy or build your new home before selling your current one. It bridges the gap so you don't have to sell the first one or move out before your new place is ready. The bank extends a temporary loan on top of your existing mortgage. So for a while, you'll owe money on two properties at once. Typically, you have up to 6 to 12 months to sell your old home. When you do sell, the proceeds directly pay down that bridging loan. So the key benefit here is that you stay in your current home until the new one is ready. There's also less pressure to sell fast. Since your financing for the new build is already in place, you can take a bit of time to get a good price on your old home. However, bridging loans are costlier due to having a higher interest rate compared to other loans, and it's a short-term loan. It's also tougher to get approved. Lenders require you to qualify for the peak debt, that's the old loan and the new loan combined. So, which option is right for you? Now that really depends on your situation. If you don't own an existing home, then a construction loan or a house and land package loan is the way to go for you. If you do own a new home, you can leverage it. Either tap into your existing loan for equity or use a bridging loan to avoid moving twice and sell your old place later. Each comes with its own pros and cons, so you have to make sure you weigh them up against your timeline and budget before you make a decision. And one final tip, always crunch the numbers and have a buffer. Building projects always cost more or take longer than expected. Make sure you've planned for possible delays, extra interest, or any surprises that might come up. Having an extra safety net of savings will save you a lot of stress in the long run. So I hope you found this video informative, and always remember to check with your broker regarding all of these options and which one might be right for you. If you found this video useful, please don't forget to comment, share, and subscribe so that we can keep bringing you more tips and info to help you with your next home build. The information provided in this video is general in nature and not financial advice.